Have you ever donated money to your church, a local charity, or sponsored a community event and thought that's a tax deduction? Maybe, but maybe not. I'm an enrolled agent with over 14 years of experience helping business owners navigate taxes, accounting, IRS rules. And today, let's talk about charitable contributions because donating money doesn't automatically make it tax deductible. Many home care agency owners love giving back to their communities. Maybe you sponsor a senior center event, support an Alzheimer's walk, donate to your church, help a local nonprofit, or contribute to a community fundraiser. Those are wonderful things to do. But here's the question: does giving money automatically make it a business deduction? Not necessarily. And that's where many business owners are surprised. Here is why. If your home care agency is a sole proprietorship, a single member LLC, a S corporation, or a partnership, your charitable contributions generally don't stay on the business return. Instead, they flow through to your personal tax return. And whether they actually reduce your taxes depends on your personal tax situation. So simply making a donation doesn't automatically mean your business gets a deduction. Now, here's where things get interesting. Sometimes what looks like a charitable donation may actually be a business expense. Let me explain. Suppose your home care agency sponsors a community senior health fair. Your company logo appears on the banners. Agency is recognized as an event sponsor. Families learn about your services. Referral partners meet your team. Or maybe you sponsor a local health expo, provide educational materials, or support a non-profit event where your business is promoted. In situations like these, part of the payment may actually qualify as advertising or promotional expense instead of a charitable contribution because the purpose is promoting business. Key question is, was there a reasonable expectation that this payment would help generate business? If the answer is yes, the tax treatment may be different than you expect. Now, let's talk about documentation because this is where many deductions are lost. Recently, a taxpayer donated thousands of dollars worth of clothing to charity. IRS didn't deny the deduction because the donation wasn't real. They denied it because the documentation was incomplete. The records didn't meet the IRS requirements. So even though the donation actually happened, the deduction was lost. That's why good documentation is so important. Save your receipts. Keep written acknowledgements. Document what was donated, when it was donated, and who received it. And here's a question I like to ask. If the IRS asked you tomorrow, why was this payment tax deductible, would your records tell the story? Because that's really what documentation is all about. One more thing. Be careful who you donate to. Giving money directly to an individual, even if they genuinely need help, is generally not considered charitable deduction. To qualify, donation generally needs to be made qualified charitable organization. So here's the big takeaway. Giving back to your community is wonderful, but don't assume every donation creates a business deduction. Business structure matters. The purpose of the payment matters. And good documentation matters. Understanding those three things can help you avoid surprises at tax time while continuing to support the causes that matter most to you. Now, here's another business expense that creates a lot of confusion. Your cell phone. Can you write off the entire bill or only the business portion? That's exactly what we'll cover in the next video. I'll see you there.